Hello friends, welcome to our channel. In this video, we would be talking in detail about various candlestick patterns and how they influence the market trends. So, we would be seeing the fundamentals of candlesticks. In this video, we would be majorly focusing on single candlestick patterns. So, let's get started with candlesticks. Candlesticks have a major advantage over charts such as bar charts because they are highly reliable and more effective in showing reversal signals. Reversal signals are the signals which are very important in determining the trend of the market. So, when a certain candle appears in an area, we can say that based on the candle that appeared, whether a market would change its trend or whether it would continue with the same trend. Also, candlesticks are important in demarcating areas of support and resistance. Support and resistance are the two major factors that we study to determine the trend of the market. Also, we can use candlesticks in our weekly, daily, and intraday trading. So, candlesticks can be determined as one of the most important features that we use to determine the trend. But risk to reward ratio has to be considered before initiating a trade. A candlestick can be classified into majorly two types, a bullish candlestick and a bearish candlestick. So, a bullish candlestick is the one having a low opening and a high closing, and a bearish candlestick is the one having a high opening and low closing. We have been using various colors to determine bullish and bearish candles. So, blue, green, or white are used to determine a bullish candle, and red or black give bearish candle. The main components of candlestick are central real body, upper shadow, and lower shadow. As we can see, the candle opens at above the lower shadow and closes below the upper shadow. So the upper shadow connects the high point to the closing and the lower shadow connects the low point to the opening. Let us consider an example. So as we can see, the opening price is 65 and the closing is 72. So that determines that the candle is bullish. So the lower shadow connects the open and the upper shadow connects the close. The low and the high are 56 and 80 respectively. As we can see, the opening is above the low and the closing is below the high. So the real body is in between the opening and the closing. Bearish candle. Similarly, as we have seen in bullish candle, in bearish candle we also have the same components. But here the difference between the bullish candle and bearish candle is the closing is below the opening. That is, it opens at a high price and closes below the high. As a result, we can see that the lower shadow is connected to the closing and the upper shadow is connected to the opening. Consider an example. The opening session starts at 456 and the low price is 420. We can see that there is a bearish trend in the session. The high and the low are differentiated with the real body connecting the both opener and the close. Let us learn more about various candlestick patterns. As we have seen, trading patterns can be found using the candlestick patterns useful in setting up an entry for a trade. Hence, they can be broken down into majorly two classes, single candlestick pattern and multiple candlestick pattern. Single candlestick pattern are Marubozu, Doji, spinning tops, paper umbrella and shooting star. In this video, we would majorly cover these candlestick patterns. In the next videos, we will cover about multiple candlestick patterns and learn in detail about those patterns. The first single candlestick pattern that we would see in detail is Marubozu. Marubozu as a candlestick pattern is one of the important candlestick pattern in determining reversal signals. So, a Marubozu is characterized by only real body with no upper and lower shadow. It does not look for a prior trend and may appear anywhere in the graph. As a result, we can see that Marubozu may also be of two types, bullish Marubozu and bearish Marubozu. Bullish Marubozu is formed when the low is equal to open and the high is equal to close. As we can see, bullish Marubozu consists of a bullish trend and it says that at every point there was a buying and the market steadily rose and closed at the high. We can also see that the sentiment has changed and the stock is now bullish. The expectation is that with this sudden change in sentiment, there is a surge of bullishness and this bullish sentiment will continue over the next few trading sessions. Hence, a trader should look at buying opportunities with the occurrence of a bullish Marubozu. The buy price should be around the closing price of the Marubozu. The low of the Marubozu should be kept as the stop loss. So, whenever a Marubozu occurs, the stock follows bullish trend and continuous off trend. It shows a bullish Marubozu along with engulfing pattern. In the figure, we can see bullish Marubozu form, and thus the stock follows a bullish trend and can be a potential entry point. Next, we see a bearish Marubozu formed when high equals open and low equals close. It indicates there was selling at every point. So, not looking at the prior trend, there is a sentiment change that we can see. A bearish Marubozu indicates bearishness. So, we should sell around the closing price of a bearish Marubozu and keep the high of the Marubozu as the stop loss. An aggressive trader can place the trade on the same session as the pattern forms, and risk-averse traders can place the trade on the next pattern formed after the current trading session. So, we have to keep in mind that we have to buy at strength and sell at weakness. An abnormal candle length should not be traded. Short candle indicates subdued activity and long candle indicates extreme activity. However, placing stop loss becomes an issue. In the figure, we can see a bearish Marubozu formed at the top, thus leading to a bearish trend in continuation. Next, we have spinning tops. Spinning tops are considered one of the major candle patterns that are formed, and it determines a large amount of trend in the market. The two things that are quite prominent in spinning tops are the candles have a small real body and the shadow are almost equal in size. They basically convey an indecision in the market. That is, neither the bulls nor the bears are able to influence the market. In such a situation, it is important to understand what decisions to be taken at the right time in order to avoid your loss and maximize your profit. So, spinning tops may be formed in an uptrend or downtrend as shown in the figure. Spinning top at the bottom end of the rally indicates that either the bears are taking a pause before they can resume the downtrend further, or the bulls are preparing to break the trend and take the markets higher. Either case, the trader's stance has to be cautious. If trader's intent is to buy, he is better off buying only the half quantity and he should wait for the markets to make the move. Spinning tops are really important in taking decision as the market is uncertain with both the bulls and bears being in equal control. Similar to spinning tops, dojis are very similar except that it does not have a real body at all and the open and the close price are almost equal. So we can see a cluster of spinning tops and dojis found and they convey an indecision in the market. A trader's decision based on doji is similar to that taken when a spinning top occurs. Next pattern we have is paper umbrella. A paper umbrella is characterized by a long lower shadow with a small upper body. Basically, they appear during two trends, that is, bearish and bullish. The hanging man is formed as a bearish trend and the hammer is formed as a bullish trend. Paper umbrella appears at the bottom end of the downward rally, then it is characterized as hammer. If it appears at the top end of an uptrend rally, it is called as a hanging man. Paper umbrella helps traders in setting up directional trades. The interpretation of paper umbrella changes based on whether it appears in the chart. The prior trend for a hammer should be a downtrend. The market is in downtrend where the bears are in absolute control of the market. During the downtrend, every day the market would open lower compared to the previous session and again close lower to form a new low. When the hammer pattern forms, there is some amount of buying interest that emerges which pushes the prices higher to the extent that the stock closes near the high point of the day. The price action on the hammer formation day indicates that the bulls attempted to break the prices from falling further and were reasonably successful. This action by the bulls has the potential to change the sentiment in the stock, hence one should look at buying opportunities. On the contrary, the hanging man pattern is formed only if it is preceded by an uptrend. Thus, the hanging man is seen after a high. The bearish hanging man pattern signals selling pressure. A hanging man can be of any color and it does not really matter as long as it qualifies the shadow to be a real body. The prior trend for the hanging man should be an uptrend. The day when hanging man pattern appears, the bears have managed to take an entry. This is emphasized by a long lower shadow of the hanging man. The entry of bears signifies that they are trying to break the strong hold of the bulls. Thus, hanging man makes a case for shorting the stock. We can see the patterns of hammer and hanging man formed in the figure given. Next patterns are shooting stars. So, unlike a paper umbrella, the shooting star does not have a long lower shadow, it has a long upper shadow. The color of the body does not matter. The shooting star is a bearish pattern, hence the prior trend should be bullish. As we can see, shooting star formation always follows a bearish trend. Thus, it is formed due to a selling pressure that is formed at the point of the uptrend. So, in this video, we covered the topics of the fundamentals of candlestick and various single candlestick patterns. In the upcoming videos, we would be looking into further details of multiple candlestick patterns. Thank you.